Imagine opening your portfolio, right, and seeing a stock that is up like 1,800% in just 3 years.
Oh, wow. Yeah, that's the dream.
Right. And this is right up to April 2026. Your immediate thought is probably that you stumbled onto the next, artificial intelligence darling.
Or maybe a pharmaceutical company that just cured some major disease.
Exactly. You would think you owned the absolute cutting edge of human innovation. But you didn't. You bought a company called Apar Industries.
Right.
And they don't design microchips. They don't write algorithms. They manufacture, unglamorous aluminum alloy transmission cables.
Literally just heavy wire.
Yeah, heavy wire that just carries electricity from point A to point B.
Which is wild. I mean, it forces you to completely rethink how wealth is actually generated in the markets. Because the companies making the front page headlines, they rarely capture the highest risk-adjusted returns over time.
So true. And that is exactly what we are getting into today. Welcome to the deep dive.
We are cracking open a genuinely brilliant framework called proxy investing.
It's a great concept. It really is. We are drawing from this April 2026 article published by Equity Decoded by Spirit. It's titled The Shadow Beneficiary, a framework for proxy investing. And our mission today is simple, right? We want to show you how the greatest fortunes in the market aren't really made on the main stage.
No, they're made in the scaffolding.
Yes, the scaffolding.
Yeah.
To give you, the listener, the lens to spot these quiet, boring businesses that are just compounding massive wealth entirely in the background of these global megatrends.
Because the foundational argument of this whole framework is that a massive gap exists between a big structural megatrend like, say, a national grid expansion or a semiconductor boom, and where the money actually quietly compounds.
Right.
The headline companies, they carry terrifying execution risks, and they carry these sky-high valuations because every analyst on Earth is watching their every single move.
Everybody's scrutinizing the quarterly earnings.
Exactly. But the hidden suppliers, the proxies, they reap all the rewards of the underlying trend without having to fight this bloody war in a hyper-competitive end market.
It makes me think of that classic gold rush analogy, right? So Nvidia is the gold miner. But the problem with being the miner is that everyone can literally see you digging.
Oh, yeah.
So the moment you find a nugget, 1,000 other miners just set up camp right next to you, which drives up the cost of land and labor.
And the historical reality of an actual gold rush is that the vast majority of miners just go bankrupt.
Right. Which brings us to the proxy. So in our gold rush, the proxy is the person standing at the edge of the camp selling the pickaxes and the shovels.
I don't care which miner strikes the vein.
They get paid either way. But the source introduces a third tier of exposure here that I think is genuinely brilliant. They call it the derivative play.
Yeah, that's where it gets really deep.
So if the proxy is the pickaxe seller, the derivative play is the person manufacturing the heavy-duty canvas that the miners use to build their tents.
We can actually map that canvas maker directly onto the US AI CapEx cycle that the author breaks down.
Let's do it.
So Nvidia is the direct play, right? They caught the initial wave and rode it, but their upside was heavily priced in pretty early on.
Right.
Then the proxy, which is one step removed, would be the data center cable manufacturers.
Because they don't write the large language model.
Exactly, but those massive AI data centers literally cannot operate physically without miles of high-grade copper and optical cables.
So then the derivative play is even further removed from that.
Much further. So in a semiconductor facility build-out, the derivative play would be like the industrial gases sector.
Okay, wait, industrial gases?
Yeah. These are companies whose primary business model has nothing to do with AI whatsoever. They supply gases to healthcare, agriculture, food processing.
Oh, interesting.
Right. But when a massive semiconductor fab goes up, it requires staggering, just continuous volumes of specialty gases to manufacture the wafers. So suddenly, the economics of this really boring chemical company become highly correlated to the AI boom.
That is wild. Because that means the analyst who's covering the specialty chemical sector probably isn't watching the infrastructure data for AI.
They completely missed the connection.
Which just leaves a massive informational advantage for the investor who actually sees the whole board. But, and I want to be clear here, the author is very strict about what actually qualifies as a proxy. Like, just being in the supply chain isn't enough, is it?
Not at all. What's fascinating here is what actually disqualifies a proxy. The source outlines 3 brutal red flags.
Okay, let's hear them.
The first one is revenue concentration. If a supplier is like 80% reliant on one specific tech giant to buy their components, they are not a proxy.
They are essentially a hostage at that point.
Exactly.
If that tech giant stumbles or, just decides to squeeze their margins, the supplier gets crushed. They lose that entire protective buffer.
Right. And the second red flag is a thin economic moat. So if a company suddenly starts expanding its profit margins and any rival can just instantly copy what they do by buying the exact same machines.
That immediate competition destroys the whole proxy advantage.
Yes. And then the third trap, and honestly, this is the one that catches retail investors the most, is when the valuation has already been re-rated by the market.
Basically, the secret's out.
Totally. If you are reading a mainstream Wall Street report that's calling a stock a data center proxy, and it's armed with a fully baked discounted cash flow model projecting 10 years of dominance, you are way too late.
The massive alpha has already been extracted.
Exactly.
Okay, let's unpack this, because that makes perfect sense in theory. But theory doesn't pay out 1,800% returns.
True.
Let's look at how this played out in the real world with Apar Industries. And I have to challenge the premise here a little bit.
Go for it.
Making aluminum alloy wire doesn't sound like high-tech wizardry. It's literally metal wrapped in insulation. Why couldn't a well-funded competitor just build a factory next door and steal their lunch? The minute demand for these transmission lines spiked.
See, you are hitting on the exact skepticism that kept the broader market out of the trade in the first place.
Oh, really?
Yeah. Investors assume a moat has to be some magical algorithm or an impenetrable brand identity. But for Apar Industries, the moat was purely chronological.
Chronological.
Yeah, the source calls it a timing moat. And the fundamental ingredient is lead time.
Okay, let's pause and visualize what that actually looks like on a factory floor.
So commissioning a massive manufacturing facility for heavy-duty power conductors is a multi-year logistical nightmare.
I can imagine.
You have to secure industrial land, pass environmental reviews, order highly specialized heavy machinery, which, by the way, usually has a 2-year wait list itself.
Just for the machine.
Just for the machines. Then you have to install it and train a workforce to operate it safely. So when the demand spike hit, competitors simply could not react fast enough.
Wow.
By the time a rival board of directors even approved the capital for a new factory, Apar was already shipping the orders. They built the capacity years earlier when land and capital were way cheaper.
They essentially built the toll booth before the highway was even finished.
Exactly.
And the investors who caught this massive 1,800% ride, they weren't waiting for Apar's quarterly profit and loss statements to drop, because by the time it hits the trailing P&L, it's ancient history.
Right. The smart money was tracking macro-level infrastructure data. They watched the Indian government aggressively funding high-voltage transmission line capacity.
Like tracking the actual physical grid expansion.
Yes. They mapped the plans to connect these massive solar parks that were isolated in the deserts of Rajasthan all the way down to the heavy power load centers in Maharashtra.
It's brilliant.
And at the exact same time, they were tracking export demand signals coming out of the U.S. grid modernization and the Middle East. The macro data was the leading indicator. The eventual annual report was literally just the receipt.
That is wild. Now, a listener might hear this and think, well, this framework only applies to physical infrastructure like cables or cement. But this translates perfectly to the absolute cutting edge of global technology, doesn't it?
Oh, absolutely. The U.S. semiconductor supply chain from 2022 to 2026 provides the ultimate masterclass in this.
Let's get into it.
So we established Nvidia as the direct play, right? Below them, you had TSMC, Taiwan's semiconductor manufacturing company, acting as the manufacturing proxy.
Because they don't design the chips.
Right, but they held a manufacturing lead that competitors literally needed a decade to close.
But the rabbit hole goes deeper than TSMC.
Oh, much deeper. The ultimate deeper proxy was ASML, the Dutch company that makes extreme ultraviolet lithography machines.
Without ASML's machines, TSMC cannot physically manufacture those advanced AI chips for Nvidia?
Literally impossible.
Wait, let's unpack that technology for a second because it really highlights why the moat is so deep. Extreme ultraviolet lithography. We were talking about machines that use microscopic mirrors in a perfect vacuum to shoot lasers at droplets of molten tens of thousands of times a second, just to draw microscopic lines in a silicon wafer.
It is mind-boggling.
It's a process so impossibly complex that ASML basically operates as a functional global monopoly.
And because of that monopoly, ASML provided the ultimate tell to proxy investors. While all the retail traders were just hyper-focused on Nvidia's quarter-over-quarter revenue, The real proxy hunters were looking at ASML's order backlog.
Right, the leading indicator.
Exactly. By the fourth quarter of 2025, ASML had amassed an astonishing 38.8 billion euro order backlog.
38 billion. Wow.
Yeah, that backlog guaranteed multi-year revenue visibility.
Here's where it gets really interesting, though, because the source material points out this massive, almost poetic irony. By 2026, Nvidia itself realized the absolute power that proxies hold. And so the biggest direct play in the world started aggressively playing the proxy game in reverse.
Yeah.
Nvidia started pouring billions into its own supply chain. By the end of 2025, they had grown their strategic investment portfolio to over $13 billion.
13 billion.
Yeah, we're talking about sinking $2 billion into Synopsys, $2 billion into Lumentum, Coherent, Marvell.
If we connect this to the bigger picture, we are witnessing a structural phenomenon called supply chain leverage inversion.
Okay, let's tie that back to our gold rush analogy for a second. This is the equivalent of the gold miner realizing the pickaxe seller has run out of wood, so the miner literally buys the entire forest just to make sure they can keep digging.
That's the perfect way to put it.
The balance of power completely flicks from the headline star to the hidden supplier.
Exactly. When a $2 trillion behemoth realizes it has to spend its own cash to lock in queue priority with its suppliers, essentially paying a multi-billion-dollar ransom just to make sure competitors can't buy the laser components they need, the supplier dictates the terms.
So if these proxies hold all the cards, why do so many traditional value investors just completely miss them until the alpha's all gone?
Well, it comes down to a fundamental misapplication of valuation metrics. People are using the wrong rulers to measure the opportunity.
Let's use a specific example from the text for this. Say a listener was looking at an Indian cable company called KEI Industries in late 2023. They pull up the stock screener and they see a price-to-earnings ratio, a PE, of 59x.
Right.
A traditional value investor sees 59x and runs away screaming. They just assume it's a massive bubble. Why does a metric like PE fail so spectacularly here?
Because PE simply measures the current price tag against today's static earnings. It completely ignores how efficiently the company compounds capital internally.
Oh, okay.
For a proxy investor, the supreme metric is ROCE, return on capital employed.
ROCE.
ROCE measures how much actual operating profit a company generates for every single dollar of capital it traps inside the business.
So the source argues that a proxy running a 25% or higher ROCE in a capital-light structure creates vastly more intrinsic wealth over a decade than a flashy headline company running at, say, a 12% ROCE on a massive, heavy asset base.
100%.
So back to KEI Industries. Yes, the PE was 59x, but their ROCE was running at roughly 27%.
They are an incredibly efficient compounding machine.
Right. They take a dollar, turn it into $1.27 of value, and just do it over and over again without needing to borrow heavily.
And you combine that high ROCE with something called asset turns. Take Apar Industries again to see structural capital efficiency in real action.
Okay.
Over a 6-year period, Apar generated 4,200 crore in revenue using a mere 343 crore of total capital expenditure.
That is crazy.
That is a net fixed asset turnover of 10.2x.
Let's just break that concept down simply. Asset turnover essentially means they aren't forced to constantly build expensive new factories to increase their revenue.
Right.
It's like owning a pizza oven. Instead of buying a second oven to double your sales, you just figure out how to run the original oven 24 hours a day, 3 shifts in a row. The capital cost stays flat, but the revenue explodes.
Exactly. But the author does issue a really severe warning regarding cyclicality here. There is a trap that will wipe you out if you confuse it for a proxy.
Yes, the trap is mistaking a cyclical sugar rush for genuine structural growth.
Consider a company supplying specialized refractories to steel plants. During a massive global infrastructure boom, steel prices skyrocket.
Everybody's buying steel.
Right. And the refractory supplier looks like an unstoppable proxy compounding at 30%. But the moment the global steel cycle busts, the supplier's revenue just collapses. They are completely captive to a boom and bust cycle.
So how does an investor test if a company is a real structural proxy or just riding a temporary wave?
The ultimate stress test is absolute revenue resilience. Does the proxy's revenue continue to grow even when the underlying headline sector stalls out? Yeah, if the tech sector has a totally flat year, but your data center cable supplier is still finding adjacent ways to grow their top line, you hold a structural winner. If
Right.
they crash alongside the sector, you're merely trading a cycle, and you should never pay a premium valuation for a cycle trade.
But hold on, I have to ask. If companies like KEI Industries are running a 27% ROCE, they are basically printing money. And in a capitalist system, outsized profits attract sharks.
Oh, always.
How long can a proxy realistically hide before the market ruins the trade?
This raises an important question, right? When do you sell? The author describes this eventual decay as the Nash equilibrium problem.
Okay, let's break that down mechanically because it sounds intimidating.
A Nash equilibrium occurs in game theory when a system locks into a state where no player can gain an advantage by changing their strategy.
Okay.
In proxy investing, your entire edge relies on information asymmetry. You see the connection between the cables and the data centers before the crowd does. But as more investors discover the trade, the price gets bid up. Eventually, the market reaches an equilibrium where the stock price perfectly reflects the proxy's future earnings.
The secret is out.
The secret's out, the asymmetry closes, and the informational edge is completely neutralized.
So the edge just vanishes. How do you actually know when you are approaching that equilibrium point?
You watch for crowding signals, and the text highlights two glaring red flags using the cables sector.
What's the first one?
The first was when the massive institutional banks arrived. When JP Morgan initiated mainstream coverage with massive price targets they put Polycab at 8,900 and KEI at 5,250, the trade was officially crowded.
Yeah, when Wall Street is writing reports literally titled The Proxy Play, you are no longer the smart money arriving early. You are the liquidity for the people exiting.
Precisely. And the second signal is when the giants invade.
Ah, right.
In 2025, massive conglomerates armed with incredibly cheap capital decided they wanted a piece of those 27% returns.
Of course they did.
So the Adani Group entered the cable space through a joint venture called Pranitha Eco Cables. Ultratech Cement suddenly announced a massive 1,800 crore capital expenditure plan to enter the business.
When apex predators with endless resources enter a niche market, brutal margin compression is basically guaranteed to follow.
Absolutely. The trade that was genius in 2022 was effectively dead by 2026.
So what does this all mean for you, the listener, right now? If the cable trade is saturated and crowded out by April 2026, where are the underpriced proxies hiding today? The source actually identifies two specific sectors that are primed.
Yeah.
The first is what they call the CDMO proxy.
CDMO stands for Contract Development and Manufacturing Organizations. These are the companies that actually manufacture complex drugs and active ingredients for the massive pharmaceutical brands.
But why are the big pharma brands outsourcing this? I mean, why wouldn't Pfizer or Merck just make it themselves?
Because the economics of drug discovery have just become brutal. Big pharma has to sink billions into clinical trials where the vast majority of drugs fail.
Right.
So to protect their margins, they are aggressively diversifying their supply chains and outsourcing the heavy, capital-intensive manufacturing. Furthermore, they are actively shifting that supply chain away from China due to geopolitical risks.
Which leaves Indian companies perfectly positioned.
Exactly. Companies like Divi's Laboratories and Cohance Life Sciences are capturing this demand. The global outsourced market is projected to hit $15.4 billion by 2029.
Wow.
These proxies benefit from massive structural pharmaceutical growth without ever having to carry the devastating binary risk of a drug failing in a phase 3 clinical trial.
They're literally the canvas makers of the biotech world.
Beautifully said.
And what's the second sector?
The grid equipment proxy. Specifically, companies operating in the high-voltage transformer and grid automation space, like Hitachi Energy India.
Okay, but again, why wouldn't a utility company just buy a cheaper transformer from some new competitor?
Because the switching costs are astronomical. Think about it. A utility procurement engineer is not going to risk catastrophic grid failure, literally plunging an entire city into darkness just to save 5% on a cheaper, unproven transformer.
Okay, yeah, that makes total sense.
Companies like Hitachi Energy hold an almost irreplaceable technological trust. By the second quarter of their fiscal year 2026, they had built a staggering order backlog of 29,125 crore. They aren't selling commodities, they're selling foundational, high-trust engineering.
Let's pull this entire framework together. The core lesson here is that the obvious trade rarely delivers the transformative returns.
Seldom.
The key to being truly well-informed and protecting your portfolio from these hype cycles is to hunt for the adjacent, unglamorous businesses. You are looking for a timing moat created by multi-year factory lead times. You are looking for a staggering return on capital employed paired with high asset turns. You want to ignore the miners and find the canvas makers.
Change your vantage point. If everyone is staring at the stage, investigate the structural integrity of the scaffolding holding it up.
I want to leave you with a final thought that builds on this proxy concept, but pushes it to the absolute macroeconomic extreme.
Let's hear it.
We talked about how Nvidia, a multi-trillion-dollar corporation, was forced to spend $13 billion buying up its own suppliers just to secure its queue priority against corporate competitors.
Right.
But what happens when sovereign nations start playing this exact same game? In a world of increasing geopolitical tension, could the ultimate final boss proxies of the 2030s be the obscure, sovereign-backed monopolies controlling the raw earth materials that these tech giants completely rely on?
Wow. The implications of that are staggering. If corporate supply chain inversion dictates market winners, sovereign supply chain inversion could redraw the entire global economic map.
It fundamentally changes how you look at the supply chain of everything around you. Thank you for joining us on this deep dive. Take a hard look at the structural dependencies of your favorite megatrends. The next Apar Industries out there right now, quietly building the unglamorous infrastructure of tomorrow, completely unnoticed by the crowd. Until next time.